Welcome to our video on how to use candlestick patterns in Forex trading. If you're new to Forex trading, you might be wondering what candlestick patterns are and how they can help you make better trading decisions. Candlestick charts are used to represent price movements in Forex trading. They're made up of individual candles that show the opening, closing, high and low prices for a given period of time, such as 1 hour, 4 hours, or 1 day. Candlestick patterns are formed by multiple candles that show a certain pattern of price movements. These patterns can help traders identify potential market trends and make informed trading decisions. There are many different candlestick patterns, each with its own unique characteristics and implications. Some patterns indicate bullish trends, while others suggest bearish trends. By using candlestick patterns in your trading strategy, you can improve your chances of making profitable trades and minimizing losses. However, it's important to remember that candlestick patterns should not be used in isolation. They should be used in conjunction with other technical analysis tools and fundamental analysis to make informed trading decisions. It's also important to stay up to date with market news and events that can impact Forex trading. By keeping an eye on economic data releases, geopolitical events, and other factors that can affect currency values, you can make more informed trading decisions. So there you have it, our guide on how to use candlestick patterns in Forex trading. By incorporating these patterns into your trading strategy and staying informed about market news, you can increase your chances of success in the Forex market. Thanks for watching, and happy trading.